All right, so 6.3 is where we start to prepare like a draft of our income statement and our balance sheet. At the bottom, you guys are going to actually calculate net income and or net loss. All right, which is a really big number. That's what you would want to learn, right? Net income, it's different than profit though. And I'll show you that a little bit. Net income and net loss is kind of a slightly different thing than profit. But we'll also see what profit is for our fiscal period as well. Depending on where it is, you can kind of call it the same thing, but we are going to differentiate from it for now. So, do a quick bit of review. What accounts belong to the balance sheet? Do you guys remember? What types of accounts belong to the balance sheets? We have assets, liabilities, owner's equity, revenue, and expenses. So which of those belong to the balance sheet? This is kind of a review. We talked a little bit about financial documents or the financial statements, I mean. So which ones go on the balance sheet and which ones go to the income statement? You guys remember? Balance sheet. I have them written up here. Balance sheet is on the left. Assets, liabilities, and owner's equity. Revenue and sales revenue slash sales and expenses are on the income statement. So the summary's up there. Assets equals liabilities plus owner's equity. That's just our accounting equation. We should be pretty familiar with that as of now. And then income statement, the equation that you use for that is revenue minus expenses equals net income or loss. All right. So for the balance sheet, you're going to come up with two different numbers. All right. One number in the debit column and one number in the credit column. And then you're going to do the same thing for the income statement. There's going to be one number in the debit column, one number in the credit column. And so our goal is not only to calculate net income or loss, but to understand what each column means. All right. And why you'll see kind of what you see. On the balance sheet, let's say you have two numbers, one in the debit column, one in the credit column. All right. Just thinking about the name of it, do those numbers have to match? Would you say that the balance sheet, the debit columns and the credit columns would have to match? You say no? You say yes? Ultimately, they're kind of both right. Ultimately, they will match, but initially they won't. Okay? And so that difference is a huge key piece of the equation, and especially one that would really, really be like one of the biggest things a business owner would want to know about their own business. All right. What about the income statement? Revenue minus expenses equals net income. So are revenues and expenses always going to be the same? Definitely not. No, for sure not. But the balance sheet ultimately does need to balance. Assets always still need to equal liabilities plus owner's equity. So what we're going to do, and I think instead of kind of going through it on these slides, the slides here have all of the instructions for what we're going to do, but we're just going to hop over to the Cengage Mind Tap and just kind of work through it there because I think it'll be better to have an example. But just know that the slides are here for you. They have step-by-step instructions on what to do. But essentially, we're going to look at our worksheet. We are going to determine which accounts go where, and we're going to extend, is the word that they use, extend the amounts for like cash, petty cash, accounts receivable, all the way down to the drawing over to their respective columns. Now, we said the balance sheet is made up of assets, liabilities, and owner's equity. Okay? If we look on this worksheet right here, these are the businesses. Asset accounts are right here, all the way through prepaid insurance. These are all assets. The accounts payable, those are liabilities. And the owner's capital and drawing accounts are owner's equity. So these whole thing, all of this, gets extended to the balance sheet. All right? Those are our balance sheet numbers. So then what goes on to the income statement column? Because you can see from this example, our balance sheet columns are filled out now, but the income statement columns are still blank. So we're going to scroll down a little bit more. On the worksheet, underneath income summary, the first line item is sales. Then you have a list of different expenses. These are all of your income statement accounts. So the worksheet is broken up nicely so that the balance sheet items are on top, the income statements are on bottom. But this is your balance sheet accounts, revenue and sale, or revenue and expenses. Revenue and sales, it's synonymous, right? We call them sales when we're making the transactions. But in an accounting, when you're talking about financial statements, at least in the United States, they call it revenue. If you go to Europe, they call it income. It all means the same thing. What did you sell? How much money did you bring in from your sales, from selling your goods? So at this point, then, let's just work through this example on Cengage then. So all we're going to do, and we're going to do two things. The first one is extend the balances. The second thing is calculate net income or net loss. So we'll break it into two things. Here we have the previous work that we did on our trial balance and adjustments. So now we're going to be working with these four columns: income statement and balance sheet. And remember, the balance sheet and the income statement too, they have debit and credit columns, and depending on where they are increased or decreased by debits and credits. So what you remember and what you know of where revenue and expenses belong.
Please pardon the interruption. If any seniors in opportunity blocks would.
All right. So remember, revenue and expenses both belong to the owner's equity portion. So we have this assets equals liabilities plus owner's equity. That's like our big accounting equation, and that's what shows up on the balance sheet. The income statement, revenue and expenses belong to owner's equity. So that's sort of like a small breakout of this part of the equation. Because just like we want to know account totals individually so we can look at and make decisions, we also want to know what our revenue and expenses are so that we can calculate net income. All right. You can't just do that by looking at this. So you do have a little bit of a breakout to do a different one. And there's even another one too for assets. All right. Assets has something called a cash flow statement that we're not necessarily going to look at because that's something that a corporation really uses. But a cash flow statement is another really, really important financial statement, especially when you talk about, like I teach an investing class, and it's the same thing. We talk about cash flow statements all the time, and that's a breakout of assets specifically, all right? But we're just working income statement and balance sheet. So all we do is we have to just work down the line here and extend our balances. So cash has a debit balance of $4,900. We need to extend that to, what do you think? Does cash go on the income statement or the balance sheet? It is the balance sheet. So it has a debit balance. So now we are going to extend that over to the debit side of their balance sheet column. Petty cash, same thing. $75. It's an asset, has a debit balance. We're going to move it. Accounts receivable, debit balance of $13.87. Supplies. Now this one is the only tricky one, all right? Well, this one in insurance, the same thing. If you look over here, supplies has a debit balance of $228. However, there's a credit in the adjustments column for $153. So we need to figure out the difference between those two, and that is what's going to go on our balance sheet. All right. Not this amount, but this amount, 228 minus 153. What is it, 75? $75 goes in there because debits are still bigger than credits. So then we're going to have a debit balance because of that. Prepaid insurance, same thing. What is that difference? 150? What is it? 250? 250 is the balance. Thank you. Accounts payable, that's a liability. That has a credit balance of 267, so that's going to go over on our credit side. The capital account has $7,443 credit balance, and the drawing account has a debit balance of $1,700. And that is all we do for our, or for right now, for the upper part, for a balance sheet. Now we have income summary. Again, that's like a header, so we don't need to worry about that, but we're just gonna move over. First one under here is sales, credit balance. Well, as we talked about, sales now is on the income statement. So now we need to report that on the income statement column for 2160. Advertising expense, debit balance for 460. And just like we said, when you guys journalized, sales was always a credit. All right. So sales is going to stay in the credits. We said expenses are debits. They always are. All right. So debits or expenses are always going to be in this debit column. $6 here, insurance expense. That, even though it's over here, be careful. It's not in a credit column. It is still in a debit column for 125. Even though it looks like it's not in line with these other ones, it still very much is a debit. Miscellaneous expense, debit 189. Supplies expense, debit 153. Utilities expense, debit for 550. So we have extended all of our balances. Now we need to do what we have done before in these, and we need to add all the totals in all of these columns. So if we add all of our expenses here, because we're going to start just with the income statement debits, that total is 1483. I did this before to save some time. So all these things added together, all the expenses, are 1483. Sales, it's just 2160. We only have one number in the sales. Moving over our balance sheet debit items, all of those add up to 8387. And since this is so these two are the income statements, these are the balance sheets. We said the income statement numbers, they don't have to match. And they don't in this case. But the balance sheet numbers, the debits and the credits, they absolutely should match. So you'd want to make sure, or actually, no, they don't match for right now. That's what I was saying. You guys were both right. So if we add up this column, 7443 plus 267 is 7,710. And so those are our totals. We're just adding down. So if we just look at this already, if we were to calculate net income, which we'll do in the next step, did this business sell more than its expenses? They have more in sales than they did in expenses. Yes. Yep. They sold $2,160. They had expenses of $1,483. So net income is going to be the difference in that. The balance sheet, though, debits do not equal the credits, and that's okay for right now because in the next step, we will make sure that they equal because ultimately they do have to equal each other. All right, so check our answers there. Next step is to calculate net income or net loss. So if the company turns a profit, it's called net income. If they lose money, if their expenses are greater than their sales, then they have a net loss. And that's absolutely possible, right? A business absolutely can incur more expenses than they did in sales because that business might still have other assets. It's not like saying that the business has $2,160 in their checking account. That's not true. That's just what their sales were from selling their stuff. They have more money. Right now, they have a balance in their checking account of $4,900. We can look at some of these other things down here and say, all right, well, this Connor Whitney, the capital account, so Connor has put in a total of $7,443 of his own money. Or perhaps he took a loan out of a bank or something like that, but he's put in that money to the company. He's taken out a total of $1,700, and there is these other assets that he owns too. So, and he turned a profit for right now, right? But we call it net income for this point. So he has a positive net income, which is good. He has a positive amount of cash. He has relatively few because he only has one accounts payable. He only has debt right now of $267. So ultimately, just looking at this, his business is doing pretty good, I would say, right? It's doing okay. But let's just get these numbers down because you want to be able to finalize these sheets. So the first thing that we do is we have to write over here net income. And we said net income then is the difference between what was sold and what expenses were. So we're going to go 2160 minus the expenses, which should give us $677. This is kind of where it's a little tricky, and I'm going to wait and I'm going to show you on the next step. It'll explain why. Because it's net income and he sold more than expenses, we are going to write 677 in the debit column of the income statement. So we're still in this debit column. You're going to write 677 here. Now, this next step, and I'll explain this right after this, 677, the next step is to extend this over to the credit column of the balance sheet. Okay? Again, we have a debit, we have a credit. That sounds about right, like what we've been doing. And we're saying that they turned a profit of 677. And so on the income statement, that looks, it's like a profit, right? But if you think about what this actually is, this business is owned by one individual, okay? Owner's equity is what that $677 is when it gets transferred over to the balance sheet. Because owner's equity is whatever is left over of assets after liabilities are taken out. So if the business turns a profit of 677 for the fiscal period, that just means that $677 of cash came into the business after taking out expenses. So what is left over of that cash is $677. And so we move that over to the credit account because it's a positive number. And so if you remember, a credit to owner's equity increases owner's equity, right? A positive return or a net income increases owner's equity. Now look at what happens if we add these columns. So the next step is to add these numbers here. 1483 plus 677 equals 2160 equals 2160 plus 0 is just 2160. We'll move down 8387. And then finally, if we add 7,710 plus 677, we get 8387. And so this is the really important one to look at. Debits equal credits on the balance sheet. And we've made the income statement numbers match as well, which I'm just going to say is not that they have to match, but it doesn't tell as much of a story as our balance sheet. Our balance sheet for sure always has to match. This is just a way to make those numbers kind of match right up here. But there is a reason why we put that 677 in that credit column specifically. Now, so let's say that expenses were more than revenue and this business incurred a net loss, all right? You would type net loss here instead of income, and this $677, it would be a loss, all right? It would mean that there were more expenses than sales in that fiscal period. And so you would just do the opposite. That number, because this column, this amount would be bigger than this. And so the difference would go underneath this credit column, and then it would get transferred to the debit column. Because ultimately then a debit to owner's equity would decrease owner's equity. So that's kind of the logic behind putting together this draft. Now, the last thing, and the reason why you do a draft of this first, is so that you can spot errors. Like, what if your numbers don't match? That's a problem. You need to have your numbers match. If they don't, you miss something. All right. And there's a process of going back in and finding errors, starting with going back and making sure that you just transferred these things over correctly. And if you did that correctly, then you have to go back to your general ledger totals and make sure you transferred those correctly. And if you still don't see any error there, you have to go back into the individual transactions and make sure you did everything. If you still can't find that there, then you have to go back to the source documents and make sure you didn't miss anything there. So there's a process of like the most obvious to the most detailed that you need to go back through to spot errors. But hopefully our numbers just match and we're all good. So why don't you guys go in now?